Hello and welcome to Beacon Pointe's Fiduciary Point of View webinar series. As a quick introduction, I am Michael DeRocco, a retirement plan consultant at Beacon Pointe Advisors. This is our fifth webinar of many planned for 2019. Beacon Pointe is a registered investment advisory firm located in Newport Beach, California, that currently advises on $9.6 billion in assets. We will be hosting a new Fiduciary Point of View webinar every 4 weeks on various topics pertaining to the defined contribution industry in both for the for-profit 401k space as well as the non-for-profit 403b space. Our goal is to bring to light various topics for both our clients as well as a general plan sponsor community and bring in experts in the respective fields to educate and inform those in attendance. Our topics will discuss various areas such as solving the millennial challenge, a DC Washington update, and hot topics for the 401k plan sponsors. Today, we are going to cover areas that help plan sponsors prepare for the annual audit. This includes providing an overview of when an audit is required and to typical audit procedures, with further insight to common plan deficiencies and best practices. With a growing insurgence of assets and participants participating in defined contribution plans, sponsors are dealing with more and more issues on how their plans are administered correctly. As we approach the Form 5500 filing date and plans are starting to engage independent auditors, if so required, now is the season for issues coming to light. Issues such as definition of plan compensation, participant notice requirements, match calculation, or late deposits into the plan are just to name a few. These type of issues can arise from small startup plans with under 10 employees to large multinational firms with thousands of employees. Today's presentation will provide plan sponsors further knowledge of defined contribution plan audits, along with some tips to help avoid these common compliance issues. We are very excited to introduce our speaker joining us today, Alex Sanchez. Alex joined Pension Insurance in 2019 as a practice leader of the firm, bringing 16 years of public accounting experience. He began his career in public accounting in January 2003 as a staff auditor with a local public accounting firm in Irvine, California, where he performed audits of mid-market privately held companies, non-for-profits, and employee benefit plans. Over the years, he became a practice leader managing a wide array of client engagements, including more than 40 benefit plan audits a year. Alex graduated from the California State University, Long Beach, with a bachelor's degree in business administration with an accounting emphasis. He is a member of the American Institute of Certified Public Accountants, California Society of Certified Public Accountants.
Thank you, Michael. I appreciate the introduction. Thank you for having me, and I appreciate everyone that is
Western Pension and Benefits Council, and serves as a board member for several local non-for-profit organizations. Now, for some quick housekeeping before we start our presentation, we will have the lines muted throughout the presentation. If you have any questions, you can type them in via the GoToWebinar chat box on your screen. We will save the last 5 minutes or so to go over any questions that come in, and we should be all wrapped up by 11:30. We have a lot to cover this morning, so with that said, I'd like to turn it over to Alex.
Appreciate everyone that is logged in and listening in on this webinar today. As Michael mentioned, we do have a lot to cover, so want to make sure that I do leave time toward the end for any questions that come up. So without further ado, let's jump into it. So one thing that I definitely want to share is anything that I can provide to help plan sponsors prepare for the annual audit, whether it's an audit that you're going through for the first time or if it's a recurring audit that's been done for your plan year after year. This might be able to add some more insight as to what we're looking for and what issues we're running into as far as these plan audits are concerned. So just a little background on us. Our firm, Pension Insurance, audits over 370 plans. This is for 2018. In 2019, we're planning on crossing the 450 and possibly 500 plans for 2019. So growing very rapidly. We are the largest EBP CPA firm in Southern California, second in the state of California. Definitely a firm that's reputable in this space and something that we take pride on is being exclusively focused on this space. A few things that we want to talk about today and what we want to accomplish is going over when a plan audit is actually needed, audit basics and process, common deficiencies, best practices, and we'll also touch on the DOL study that happened in 2015. A report was actually distributed in 2016, but the study happened in 2015, and we'll touch on what it talks about and what the importance of it is here shortly. So when a plan audit is required, so let's go over this. Typically, you tend to hear that generally having more than 100 participants is what really triggers the audit. And that is typically the case, and it's a general rule, but there is an exception to that rule. And so that exception to the 100 participant mark, and that's based on eligible participants at the beginning of the plan year. So when you say, beginning of the plan year eligible, that number is what gets posted on the 5500 year after year in that first page of the Form 5500 filing. So it's very important that the plan census information is accurate and complete. And that eligible number, if you look off to the left of the screen with that eligible number, it's not only active participants. And that's something that is a misconception that, the plan census should only include people who have either balances in the plan or who are actively participating in the plan, but that's not the case. This number can actually ramp up very quickly for a company that might have only 50, 60 employees, because you've got in that eligible number, you've got active participants that are included in that number. You've got people who have separated from the company but have balances in the plan still. And you've got also just eligibility is what puts you on that census and on that head count. So if you have a plan that, say, an individual is eligible after 3 months, but they're not participating, or even, what's popular is the auto enrollment feature, where you've got people who are auto enrolled immediately but not participating, that individual, as long as they're eligible, would be included in that count. So very important to pay attention to that count specifically and how your plan is designed. Does it make sense to have people auto enroll immediately, or is it better to have a 6-month provision, for participation purposes in that plan? Now, the exception to that 100 is the 80-120 rule. And so this 80-120 rule, it was put into place because you've got companies, the DOL does not want a company that's hovering at that 100 employee or active or eligible employee mark every year to be teetering and tottering between having a plan audit 1 year and then not having a plan audit the following year if you go below the 100. So they made this rule for a company that's basically ramping up and growing. So you've got a company that's got 80 eligible employees and it jumps up to 90 and then 100 and goes over 100. And then, it's hovering around that 100 mark. They don't necessarily require the audit just because you went over 100. They created this rule so that you basically can follow what you did the prior year in terms of the filing. In this first example I listed here on the slide, a company that has 118 participant count that filed as a small plan in the prior year can use a small plan waiver until you reach over 120. So the real magic number for a company that's growing is 121. So once you reach 121, then that audit is going to be required every year until you go under 100 participants. So that's really why that 80 or where that 80-120 rule comes in. So the other misnomer is that if you have an initial plan that's set up in year one and it's got over 100 employees at the beginning of the plan year, that plan itself requires an audit because the 80-120 rule doesn't apply in that case. So that's why, it's kind of confusing. You've got plans that do have 105 active but get audited, and that could be the case where a plan is just set up initially and it's got over 100 that first plan year. And then you've got others that have the same type of setup where they've got, let's say they start the plan with 90 and then goes over 100 in year 2 and they don't require the audit because the 80-120 rule actually applies to them. So in example 2 here, you've got a participant count with the same number, 118, but in the prior year, they had 122 participants and filed as a large plan. So that in year 2, when they have 118, just like in example 1, in this situation, you actually do need an audit because they filed as a large plan in the prior year. So I hope that makes sense. But again, always available to answer questions if there's anything specific that is taking place with your plan. Auditor's role and opinion types. There's this misconception that if a plan gets audited by a CPA firm that, every error, every mistake, every fraudulent activity is going to get caught through the audit, and that's a complete misconception. So I wanted to stress and list out what the auditor's responsibility is with regards to the plan audit and the types of opinions that get issued. Auditor's responsibility is to issue an opinion on whether the financial statements are reasonably stated in accordance with generally accepted accounting principles. So we look at the plan in its entirety, financial statements, net assets, and then form, based on materiality levels, an opinion on those financial statements. So we're not looking at every single transaction that takes place throughout the year. There's just no way that can happen. So it's all based on audit sampling, and we want to make sure that we look at all the different facets of those statements and those numbers to make sure that we can get comfortable providing an opinion on those statements. The audit is the process of gathering sufficient evidential matter to support the accountant's opinion. And we'll use audit sampling, and we'll talk about the process that we go through in order to get to that point. And then the audit itself is performed in accordance with our generally accepted auditing standards that kind of is the guide that we go off of. Types of opinions that get issued with these statements. So I'd say probably between 95 and 98% of these plans are limited scope in nature. And we'll talk about what the difference is between a limited scope audit and a full scope audit, and what makes a full scope audit versus a limited scope. With that said, because you've got the vast majority of these plans that are limited scope in nature, the opinion that you're going to see issued on these financial statements is going to be a disclaimer of opinion. So it's that third definition down under the types of opinions. And that's basically, it's a limited scope in nature because having a certification letter from your record keeper, which allows us to perform a limited scope audit, is something that auditors don't have to recreate the wheel for procedures that have been performed at the record keeper level. That's why that is, and we'll talk more about that. An unqualified opinion is the cleanest opinion that you can get, and it applies to full scope audit where the investments are tested and a full scope audit is performed. A qualified opinion is when the financials are reasonably stated, but you've got an exception. There's an area in the financial statements, a specific area, whether it's benefit payments, whether it's the investment balance, or it could be the administrative fees, or one line item or a couple line items on those financial statements. The auditor could not get comfortable with that balance. The financial statements are reasonably stated, but there's an exception. And that exception would be documented and specified on the audit opinion, the audit report. So that's where qualified opinion it happens. And then the worst case scenario would be an adverse opinion, which is the fourth one down, where the auditor says financials are not reasonably stated in accordance with GAAP. And typically, if this were to happen, if an auditor were to run into this situation, which is extremely rare, the auditor would generally withdraw from the engagement and basically kick it back to the plan sponsor to work with the record keeper, try and clean things up, reconcile numbers, so that we can get to that point to where either a disclaimer or an unqualified opinion would be issued, depending on the situation. So that's very rare. Something that I hope that you never have to experience yourself. Limited scope audits. What makes a limited scope audit? And this basically, if you have a bank, a trust company, a similar institution, or an insurance carrier, basically a record keeper that can provide a complete and accurate certification on the investments and the net assets of the plan, then that would allow the plan auditor to issue a disclaimed opinion and perform a limited scope audit. That's basically what triggers or what allows the auditor to perform a limited scope audit. Without that complete and accurate certification, which is a simple, typically 1 to 3 pages in length, where the record keeper certifies the information and it has to have specific language to it, that without that certification, then a limited scope audit can't be performed, which raises the fees on the audit because there's just more procedures that have to be done in a full scope audit versus limited scope. Primarily when it comes to investment balances and transactions from testing, that's really where the difference lies. If you have a limited scope audit, it doesn't mean that the auditor doesn't have any work that they have to do. They still have the responsibility to test participant transactions, contributions, and we'll talk about some of the other things that we look at as part of a limited scope audit, which is typically what you'll see out there. For this slide specifically, the one thing I wanted to stress is that proper planning is really key in all of this. You don't want to call your auditor late September, early October with an October 15th ultimate deadline and ask for this audit to be performed then, because it really takes time to go through this process. There's a lot of moving parts and components to this. You've got your record keepers, you've got your third-party administrators, the plan sponsor, the auditor, and you've got different team members that are touching the plan at the plan sponsor level, including the CFO sometimes, you've got the controller, you've got the VP of HR, you've got your payroll personnel. So there's a lot of coordination involved and people that are touching the plan. And so it really takes time to go through this process. And this is why I listed these things on the slide, because you've got typical documents that are required. You've got different schedules that are coming from different places. The audit packages typically come from the record keeper. Timeline, what we typically say for a timeline is that once the audit package and the schedules and supporting documentation is provided to the auditor, it usually takes the auditor about 6 weeks from the time the information comes in to the time the financial statements get drafted out. And once those statements get drafted out to the plan sponsor has to take ultimate responsibility over those statements because we have to be independent. So it takes time for the plan sponsor to really sort through the audit report, the audit opinion, the financial statement, and gain that understanding of what those disclosures mean through conversation with your auditor to make sure that you're signing off on what you feel comfortable with those statements. And that takes time, having that dialogue back and forth to get to that point to where statements are finalized and ready for that 5500 filing. So what are auditors looking at? What do we look for? We're not only looking at plan level information, but we're looking at participant level information as well. So we want to make sure that the financial statements as a whole tie out to what the 5500 is reporting. So that's why we look at plan level information. But then we also look at participant level activity as well. That's how we look at whether those contributions are actually going through in accordance to what they had requested. The distributions get paid out in accordance to the plan document, that any forfeiture funds are being treated the right way. So there's different things that we look at, and some components require participant level information and others require just plan level. So we do ask for both. And then as far as what the areas that we look at specifically, you've got new enrollments. Typically, if a plan has been audited year after year, then what we'll look at is new enrollment, because if there's something we haven't looked at is what's happening in the current plan year. So we'll look at new enrollment, new participant loan issuances for that plan year. We'll look at distributions, and we'll make selections to test all those different areas in a way that's based on audit risk. So those are just some areas that we look at, but it's all based on the plan design and what the plan has going on. Common plan deficiencies, these are the things that we typically see come up year after year. And still to this day, even though this rule has been in place for years, late remittances keeps coming up as a number one issue. We've got, whether it's having turnover in the department or having a change in service providers, where typically have a different process when that happens. Late remittances tends to come up. Things happen as the operations, the company is growing, and you've got different moving parts when it comes to payroll processing, and you've got vacations, you've got people moving left and right. That's where we see issues. Not having proper cross-training, having different levels of supervision to where if somebody goes on leave, that the company feels comfortable that somebody else is picking up the pieces and making sure that payroll is being processed correctly, that the remittances are being done timely. And then excluded participants. So the plan census information is key. That's really where this stems from. So if you've got whoever handles the plan census information and populates that at the end of the year or on a quarterly basis for your TPA or record keeper, having a second set of eyes is what I would suggest. And maybe even having department heads look at it to make sure that the census information is, at least from a head count perspective, that it looks to everyone before it gets submitted, because you don't want to exclude participants. It also, that fifth one down the list, non-discrimination test issues, that tends to come up because of the inaccurate reporting on plan census information, because that's what they use. That's what record keepers and third-party administrators will use in order to calculate for year-end testing. And then the fourth one down, miscalculation of employee and employer contributions. That kind of goes hand in hand with the definitions of what we have in the plan provision. If you're miscalculating or if you're misconstruing what the definition of plan compensation is, then you're going to have miscalculations at the employee and employer contribution level as well. So those are the ones that we see that tend to pop up over and over again. So best practices over the years, I've been doing this for 16 years now, and what I tend to see is that plans that have great governance and oversee their plans with these types of things that are listed here on the slide tend to actually perform better, have less issues, penalties, assessment, or holes in the plan. So these are the things that I like to recommend for plan sponsors, especially because what we're looking at are really plans that are larger, over 100 employees. So setting up a formal retirement plan committee. And if that's made up of your CFO, somebody in the finance team, somebody on the HR side, you've got your service provider, whether it's an advisor that's governing the plan from a 316 fiduciary perspective, you want to make sure that you've got a team of people that is overseeing the plan. And part of that involves reviewing and benchmarking fees. The second note down, you want to make sure that this gets done. From what I've gathered, 3 years is typically a good time to benchmark fees. You want to do it every 3 years. Or if there's significant changes to the market, the industry, where you've got a situation where fees that are really volatile from 1 year to the next, it may make sense to do it before 3 years in a certain situation. So that's something that you want to look at. You definitely don't want to let that go 5, 6, 7, 10 years before you start going through a benchmarking of fees at the plan level. Reading and understanding the plan provisions contained in the plan document. Again, you want to make sure that plan document is accurate and complete, putting in controls as well. And then also the most important role for a fiduciary is to hire qualified service providers to service the plan itself. How do you assess your auditor? What do we look at? Just because a CPA has that certification doesn't mean they have expertise in ERISA plans. So you want to make sure they have specialized training in auditing ERISA plans. You also want to make sure that the firm is devoted and dedicated to the space. So how many plans does the firm audit? It's very important. And even at the office level for a national firm, you might have a national firm that audits over 100 plans, but what does the local office do? Do they really have the expertise at that local office? That's a question you might want to ask just to make sure. And is the auditor putting the plan sponsor on a watch list? This is something that comes up way too often, where you have an auditor that follows a checklist of items, and every issue that comes up gets reported on the 5500, and it puts the plan sponsor in a bad predicament, because if you report all these things that don't necessarily need to be reported on a 5500, then this information is public record. So it ends up possibly putting the plan sponsor and the company in jeopardy from a DOL audit standpoint. So that's something to be mindful of. You just want to make sure you find the right balance between having enough experience to move through the audit efficiently. The last thing you want is to have an auditor in your office longer than they need to be, taking up time from your finance team, your HR team, and having them spin their wheels trying to get an audit done and taking longer than it should be. I know we're running short on time, so I'll touch on the DOL audit quality study from 2015. Basically, skipping to the next slide, this recaps it well. The DOL performed this study and identified that there's a direct correlation between the audit quality and the expertise level of the auditor, basically. So there's 4,800 audits that were performed by 3,684 firms that only did 1 or 2 plan audits a year. And for those audits, they found 75.8% worth of deficiencies. So that's an extremely high rate. Whereas you see auditors perform over 100 plan audits a year, they only see a deficiency rate of 12%, which in my opinion is high. You don't want to see deficiencies. You want auditors that know what they're doing as far as the process is concerned, and you want that to be zero. But it's still, when you look at that disparity, it's huge. And that's what the DOL is finding, is that they're looking at plans that are being performed by inexperienced auditors as potential ones to audit themselves and to really investigate. So they're just preaching and telling, go through the process of being diligent when selecting your auditor. And because of that, they've put out more and more research and guidance online for plan sponsors to look at. So they've provided lists of auditors that are part of the Employee Benefit Plan Audit Quality Center. And so you've got links that'll help you find that information and get comfortable with that process. And that's basically the end of the presentation. I'll give it to Michael to kind of run with it from here. Thank you all for your time. I appreciate it.
Well, perfect. And thanks, Alex, for all that audit information. Now I'm going to be looking at the chat box, and I see a question coming in. And essentially it expresses, you talked a little bit about the common deficiencies noted during plan audit. The question is, what would you say are the top 3 deficiencies you typically see as your firm is out auditing plans?
Yeah, it's a great question. I think number 1 has to be the contribution timeliness, and it's so subjective. You've got plans where if you have a consistent pattern of doing the remittances every single payroll, and let's say it's 3 to 5 days, then a DOL auditor can come in and say, okay, well, if you did it 3 to 5 days for 6 months and there weren't any changes in record keeper or payroll service provider or anything, and then all of a sudden you have these 1 or 2 instances where it took you 10 to 15 days, they could easily identify those 2 remittances as being late and assess penalties for it. So you want to keep it as consistent as possible. no longer are the days where, the original rule was 15 days after the month of payroll. So if, let's say, we had a payroll remittance that happens July 1st and that wasn't remitted until after August 15th, they would identify that one as being late, right? And it didn't matter how consistent or inconsistent you were, but that was really the hard and fast rule. Now, no longer is that the rule. Now they're looking at reasonableness based on what your plan operation has been doing in the past. So they'll look at historical records and make sure that you're just doing it on a consistent basis. So if that track record shows 3 to 5 business days, and they want to see that consistency across the board. I'd say the second one has to do with plan compensation, the definition of plan compensation. That comes up often, especially when you have so many companies now with a lot of temp employees, part-timers, figuring out what type of wages should be included. You've got bonuses, you've got fringe benefits. Should those be included in that calculation? Should they not? Really identifying what the plan document is telling the plan sponsor to do and setting up the right payroll codes with your service provider, whether it be a large service provider or sometimes you see a switch in service provider from, let's say, a ADP to a Paychex or a smaller payroll provider, making sure that when that happens, you're revisiting the systems and making sure that those payroll codes are being accurately coded so that your remittances are being done accurately.
Perfect. And then have you ever seen or heard of the DOL or IRS performing investigations on smaller size plans, or are they largely focusing on the larger size plans?
Another good question. It used to be that a lot of these investigations were being done on larger plans because the DOL could actually spot and really assess higher penalties for a larger plan because you've got generally higher assets in the plan at that point. But I've actually seen smaller plans get investigated by the DOL all the time, whether it's between 100, 200 employees, and typically not as random as you might think. With everything being so automated nowadays, you've got 5,500 that DOL investigators can sort through and really dive into very swiftly and very quick fashion to be able to identify those plans that have reportable transactions and issues with them that they can go in and investigate further. So it's not a random thing. And so that's why you want to be mindful of what you're filing and what you're putting out there for anyone to see, because it could create a situation where you see a DOL audit letter investigation open because of it. So I've seen it both ways, large plan, small plan. I don't think it matters anymore.
Perfect. Well, that brings us to a conclusion of our Beacon Pointe Fiduciary Point of View webinar. I would like to thank Alex Sanchez for joining us this morning and sharing his valuable insight on key topics we can expect to encounter in the coming year. This is Michael DeRocco, a retirement plan consultant of Beacon Pointe's Retirement Plan Services, and thank you all for joining. If you would like a copy of the presentation or have any questions, you can reach us at bpawebinar@beaconpointe.com. Again, that is bpawebinar@beaconpointe.com. Thanks again, and be on the lookout for the invite for the next Fiduciary Point of View webinar.